Hello and welcome to India Market Open. It's a holiday shortened week, so I guess everyone's excited. Long weekend ahead, and we're of course dressed on the occasion, celebrating 26th of January. Good morning, guys.
Happy Ganatantra Divas.
Ganatantra Divas.
Happy Ganatantra Divas
I love
in
that.
advance.
I love the ring to it.
Yes, absolutely. We're here to celebrate, of course, a big day because markets will be shut tomorrow, and it's going to be an interesting day in the markets as well. Even one day ahead. A lot of global cues to track. Nothing spectacular in terms of the quantum of moves on Wall Street, but do note that the S&P 500 and the Nasdaq have managed to close at record highs. So that is positive. The Dow a little down because of numbers that have dragged them down. Remember, the focus in the US is also on the quarterly numbers. And look at what's happened with Netflix. Netflix was up nearly 10% in trade, record subscriptions, all-time high subscription numbers for Netflix. Tesla came after market hours, but Tesla is an important set of numbers to look at because they've seen a drop in revenue, they've warned of slower growth, and this is going to impact China as well as the EV maker sees demand sort of dropping off. So that's at least the Wall Street picture. You saw that playing out on yields as well. And remember, important data is expected later tonight for quarterly GDP. The 10-year has hardened ahead of that, and the estimate for Q4 GDP in the United States is about 2%. Couple that with strong PMI data which has come in last night, and that's giving you a picture of a economy which is recovering quickly. The problem is that going to spike inflation again? So those are some of the conundrums as far as US data goes.
Yeah, talking about that, of course, this might not move our markets, but significant. Microsoft touched $3 trillion briefly on the exchanges. I mean, this is larger than some of the economies in the world. It's a giant in itself and pretty significant, I'd imagine, first time making history.
No, a lot of data points, by the way. So, one, Microsoft doing what it did. Two, while Tesla has done what it's done, does BYD follow suit? Because BYD has upstaged Tesla as the largest car maker. Three, I was reading a report from Carbon Briefs which suggested that China added in green energy alone the economy of a Switzerland or a Turkey in 2023. Wow. So the quantum of investments that they're doing is pretty large as well. So lots of very interesting data points. It would be interesting to see what Tesla does today, now that it's down post-market hours about 6-7%.
It's largely AI, it's largely green.
NVIDIA, AI and green absolutely is the theme. Agreed completely. Just to round up a couple of more cues that you should know, Brent is back above $80. That's because US output figures have been low. A huge blast of Arctic weather has muted production there. And just quickly look at Asia. So interesting things happening in the Asian markets and a mixed sort of bag. What's important to remember is that the Chinese government, the Chinese central bank is beginning to make moves to boost that economy. So they've actually cut the reserve ratio to boost the Chinese economy. And you're seeing at least Shanghai doing fine, but a mixed sort of bag there. So a lot of factors to look at, but the question is that the recovery that we saw at close yesterday, will that stay up? And before I hand it to you on that, Niraj, I just want to quickly go through the fund flows numbers because they're interesting. It's almost an even Stevens. FIIs sold 6,900 crores yesterday, but DIIs bought about 6,000 crores yesterday. So it's not the FIIs that rescued the markets at closing. It is perhaps domestic investors who came in.
But you know, Tamanna and Niraj, just a quick one on the FIIs. Well, we've been very concerned about those numbers. In percentage terms, they haven't actually sold extensively either, right?
True. Fair point.
Yeah. But so largely a short covering led up, you would argue yesterday, because if you just look at the quantum of sectors or the kind of sectors that moved up as well, mainly beaten down sectors. So this short covering, is it welcome? Yes. Does it signal a resumption of a trend? No. Remember the start of the week, viewers, we mentioned that very unlikely that in a truncated week you will really have a significant trend building piece, especially because India has 2 days short on the trading side versus the rest of the world. So very unlikely that would have happened. And frankly, let's not think of yesterday's move as a resumption of a trend for sure. In fact, for most people that I speak to, the largest risk remains the SPX pricing in no rate cuts in the month of March and thereby having a bit of a pullback as well, because hitherto even now the markets, based on the plots that we have, still believes that there could be a rate cut in the early half. If that is not to come in, does the market react? And if the SPX reacts, do the other global markets react? Because let's face it, the US market's the mother market of all. If the US sneezes, the world will catch cold. Just one pocket really before we talk about stocks and an interesting data point as well. Based on commentary as well as results, it certainly seems that mid-cap IT as well as auto ancillaries might be pockets to monitor. We've seen consistently decent numbers from a clutch of mid-cap IT service companies or product companies, as was the case with Persistent, as the case with Birlasoft. We'll talk about it today. We'll get the management later on today as well. And auto anks, I mean, from a Sona Koyo or a Sona BLW, excuse me, the erstwhile Sona Koyo, or a Seat now, or a BKT, some pretty interesting names there. And guys, just before we move to stocks, a very interesting development. So the first time that we are seeing the flash India PMI numbers come out, sponsored by HSBC, and therefore they are doing this study. But it's the first time that this data point is being put out, about 7-10 days before the actual PMI numbers come out. So, and they provide, as per the HSBC note, they provide an advanced indication of the final manufacturing services and the composite PMI data. And the data showed that for the month of January, both manufacturing and services grew at a very fast clip. In fact, business services are the fastest in 4 months. The only dichotomy is that while manufacturing grew at a good clip and was able to maintain margins, services were not able to. Now, the note itself says that you win some, you lose some. So you won sales for services, but you've not gotten the margins. But seemingly that is okay. But the key part is that the main point, that exporters were able to report higher sales across global regions. So they've cited all the regions. It pretty much covers the whole world. So it covers Europe, rest of Asia, US, the Pacific region, and LATAM. So across the regions, Africa, exporters were able to register very strong sales thus far. And it goes to, if this data continues that way, it'll be very interesting to see what actually happens to the GDP numbers at the end of Q4, which of course we'll know only in May or June. But the flash PMI numbers, the first time that such a data has been released, is pretty strong.
I'm wondering how much the street will take into consideration flash PMI.
Possibly nothing. It's just the first time.
Better,
but it's an interesting data point to monitor for sure.
And it ties in well with the kind of numbers we are seeing from the exporter companies, right? So Bajaj Auto or TVS Motors, you've seen exports actually going up. So I guess the macro trend very obviously reflects in company earnings as we see it. So if you've got to take a step back, while GDP, this is also a precursor to what we can expect maybe from other exporters.
So it's great, right? The October, November, December numbers are good. And this is January, which is pointing towards good numbers.
So you know what the next quarter is going to look like.
Cross fingers.
Well, that's, of course, the flash PMI, but a quick mention on some of the other aspects of the market which we'll touch upon. So while there was a very smart recovery, like Niraj indicated, second half of trade, Bank Nifty did not provide its support. In fact, Bank Nifty was a corollary to what happened on the Nifty in trade. Opened with a gap up, but finally went home very, very flat in trade. HDFC Bank, surprisingly, was the only bank that did okay. Has it found its bottom is anybody's guess. But at 1370, you did see the buying coming in to take the stock up to 1455. Maybe a little bit of a short-term relief is what we've got. I'm not clear what the ADR closed that in trade yesterday, but that'd be interesting to find out as well. Apart from that, all your other banks were down and out. Another sector, Niraj and Tamanna, both of you can come in on this one. You had some relief coming in from China in terms of a package for the banks over there. You had a weaker dollar, and all that garnered really well for metal stocks in trade yesterday. So across the board, stocks were up 4 to 5%. The index was up 2.5–3%. I'm assuming the trend should follow on to trade in today's session as well. So oil and gas, metals to add to your list of auto ancillary and mid-cap IT.
Yeah. Just on China, a point that you were also making yesterday, Samina, about where foreign flows are going and if they will go. So mixed views over there, but the fact is that China is going to put out some very strong moves to defend and improve that economy. The reserve ratio for lenders is just the first, perhaps, of what we'll see. So one space to definitely watch out for.
And valuations, I mean, not that I'm saying China is a better place than India, but at least on the valuation front, it may start looking a little more compelling than some of the other emerging markets or markets across Asia. But let's quickly move on to stocks. We've got lots and lots of earnings. I'll take you through the three larger ones. And then, of course, these are larger, not necessarily the biggest movers of the day, but nevertheless significant in terms of the kind of numbers that we are seeing in. Tech Mahindra reported numbers. Revenue was marginally higher by about 1.8%. Margins have expanded about 181 basis points. Net profit has also come in 3.64% higher. The key takeaways, and I think that's what I'll quickly wrap you through. Key verticals for Tech Mahindra remain under pressure. They continue to see pressure in CME. Headcount decline, remember, has been a pressure point for Tech Mahindra, and we continue to see that as a red flag for Tech Mahindra. Apart from that, margins have improved, but they still remain a challenge when compared to industry-wide margins. The street is also going to be very clearly focusing on the restructuring under the new CEO. That, though, might be a few quarters out, but that really will be the biggest trigger you want to watch out for with Tech Mahindra. Meaningful recovery also remains a few quarters out for Tech Mahindra, so not too much clarity. The stock, be interesting, went home with a 3% gain. It's done 11% through the month. What happens today may be a little bit of profit taking, but given that the broader sentiment is positive, you may see a little bit of an uptick and then a little bit of profit taking that could emerge in the second half itself. I'll move on to TVS Motors and Bajaj Auto. TVS Motors as well, numbers largely a mixed bag. Revenues were up substantially. EBITDA has also come in higher. Margins have improved too. And you've also got net profit that has seen a huge bump up. What you want to remember is non-core income. So the treasury income, investment income has actually boosted those numbers. So while the numbers on the face of it looks fantastic, year on year, it's their non-core operating income, so non-core business that's actually helped those numbers. So business is coming, or revenues are coming from outside the core business. Exports, though, look very strong. I was tying back to what Niraj was highlighting on Flash PMI. Exports for TVS Motors have actually been spectacular for the quarter. They've also gained market share across scooters and motorcycle. Norton, which is a UK subsidiary, will take 2 to 3 quarters to start actually showing an impact on its top line. Valuations, though, brokerages believe still remain quite stressed. So that's the valuation picture, and hence I said it's a mixed bag. Numbers largely looking good, but of course, whether or not there's how much legroom the stock has is going to be anybody's guess. Bajaj Auto. Kunal quickly mentioned those numbers as well. Revenues have come in higher. Margins have also improved. Takeaways on them is their motorcycle franchise continues to drive earnings for Bajaj Auto. They've been focusing, just like, for example, United Spirits yesterday, on the luxury market. And that is doing really well for Bajaj Auto as well. And this will be the key driver for their earnings and their margins for the next few foreseeable quarters. Exports for this one remains subdued. So while TVS Motors has done really well on the export front, Bajaj Auto has not managed to pick up too much market share with regard to exports. But what they've done well on has been the higher three-wheeler sales. TVS, on the other side, has seen weaker three-wheeler sales. So very sort of opposites in terms of what they've reported. But in both cases, it'll be interesting to see how the markets respond to that. With the auto majors came Seat and Balakrishna. We'll take you through those in a few minutes.
I know. I just wanted to, on Bajaj Auto, you're absolutely right, but I just wanted to point out what Morgan Stanley is saying, that they expect the next tailwind for Bajaj Auto to come from exports. So that might change over the next few quarters.
But yeah, no re-ratings as such yet on either of those, or three of those stocks. They all seem to be maintained by most brokerages. Yeah.
The other big one, of course, to watch is Tata Steel. Those numbers came in yesterday as well. Revenues down 3.1%, but EBITDA was robust. The margins also improved, as well as to the profit. So just quickly take you through what Morgan Stanley is saying. They maintained equal weight with a price target of 120. They're saying that the domestic EBITDA is beating estimates on higher realizations and better costs, but again, an export problem over there. The European business is remaining a drag, and the higher beat is actually led by other businesses. Higher steel demand growth is likely to come more domestically from India, and that's key for Tata Steel. But international steel prices and the whole Europe business has been a drag for Tata Steel for a while, and that continues to be a concern. RailTel is the other one that I wanted to focus on, where revenues are up 11.5%, EBITDA is up 3%. Now, RailTel, again, one of those rail stocks which has been on a very hot streak, so it was always interesting to see what their numbers look like. Numbers overall look good. The higher cost of projects has weighed in on margins to some extent. So you're seeing margins there a little muted down, about 147 bips, but not too much. And then that's impacted profits as well. So RailTel, definitely one to watch out for. But ahead of the budget, the vote on account on the 1st of Feb, all rail stocks are on a different kind of trajectory overall. DLF, we saw yesterday Purvankara doing very well. Kolte Patil numbers were out. And let's look at what's happened with DLF. Revenues up just about 1.8%, but your profits and margins are looking decent. And with these companies, the sales booking number is what you would usually look at. The sales number, the booking number is good at 9,000 crores out. And again, DLF has been doing very well in the luxury segment with their premium projects getting picked up very quickly. So we'll see what happens with DLF today in trade as well. But so many stocks on the list.
It's just a long list. I want to start, by the way, aside of Raymond, and I think there's an ET note which says that the talks between the chief and the wife have collapsed. So it'll be interesting to see if Raymond has a major reaction today or no. But I want to start off with Birlasoft. And if you can pull up the last 6 months chart, you will know why Birlasoft is important. The last 1 month, about 11% gains. The last 6 months, 117%. The stock has doubled. So imperative for the company to put up a good quarter. Have they done that? Well, revenues up 2.52% at 1,342 crores. The estimates, the Bloomberg estimates were 1,333. So the revenue numbers exactly in line with estimates. The EBIT margin, 14.38. The estimates were 13.5. And this has been the story of Birlasoft ever since the new management takeover has happened. That they're inching up their margins, clawing back on the margin front, which is positive. The PAT up 11%, 161 versus estimates of 142 crores. So clearly, relative to estimates, Birlasoft has done well. Has it blown the street away? Maybe not, but 11% PAT uptick is not something that the street would be unhappy with. The 2.5% revenue uptick may be ho-hum. You'll hear the management, of course, at 9:45 today on NDTV Profit. So that's a conversation you don't want to miss, considering what the stock has already done. Chalet Hotels is the other one. We know hotel companies are by and large giving good numbers. The reason why Chalet is important, it'll be because of the bottom line. But let me take you to the top line first. 29% uptick in revenues, 373, estimates were 354. So you could argue a beat there, more than 5%, so qualifies as a beat. Margins expanded 525 basis points to 44.43 versus estimates of 42.8%. So relative to estimates, margins too very strong. The PAT number, it's down 31% optically at 70 crores, but it's ahead of the estimates of 55 crores or 54.7 crores. And the reason why the PAT is down, the reported PAT is down, because there was a one-off in the corresponding quarter last year, a one-off income of 60 odd crores, as a result of which PAT is down 31. But reportedly 70 crores versus 56 crores or 55 crores, so better than estimates. So watch out for maybe a positive reaction from Chalet as well. That's the other one. You know, at the peak of COVID, the stock was at 150. In 3 years, it's gone up to 750. That's a 5x return. Just goes to show what happens when you buy a good company at the bottom of the cycle. The third one is CEAT. There is also brokerage notes, which we'll talk about very quickly, but CEAT is the third one. Revenues expanded 8.6%. Margins expanded 537 basis points at 14.08 versus 13.8. And net profit, 181 crores. I mean, that 400 percentage point expansion, notwithstanding that it's up 5x, but 181 versus 160. So clearly a beat out there as well. So 3 stocks on results. What else, guys?
There are lots more on results, and I know we are short of time, but I'll just quickly highlight what you want to watch out for. We'll, of course, have links through the day to take you through those numbers. You had DCB and PNB both reporting numbers. You had Dalmia Bharat, Quick Heal, actually very interesting on Quick Heal. It's a really small company, but they've gone and had a massive change in the way they've done for the quarter versus a 10 crore, have reported at 11 crore profit versus a 10 crore loss in the last sort of year. But yeah, we'll add to that list, but lots of numbers. You've also had Borosil on fundraising plans. You've got a couple of big meetings as well lined up. So I think a lot of it is going to be, you will catch some of the management on the channel and over the course of the week. And
just a couple of more I would add. One is this coal gasification scheme, which has come in, and it's an outlay that the government has announced of 8,500 crores. I'd watch out for Coal India. Anyway, news on Coal India and BHAL will invest over 11,000, nearly 11,800 crores in a coal to ammonium nitrate JV project in Odisha. They have another project with GAIL in West Bengal of over 13,000 crores. So that's one to watch out for. Just in government-run companies, NHPC is another one you might want on your radar today.
Yeah, I mean, some of the OFS already done, so therefore some recovery seen there in NHPC already back to 80. Let's wait and watch what happens there.
The OFS is at a discount price.
Yeah, so but part finished already. The last point before I hand it over to Alex is the Citi note on Petronet LNG, negative catalyst watch, target price of 185. Watch out, they say switch to IGL versus Petronet LNG. Okay, let's take it to the editor's cut now because there's a very important piece around what is arguably the most talked about stock the last few days, weeks, I could argue, Alex, for the last few months.
Certainly. The first narrative, Niraj, was when is HDFC Bank going to play catch-up? And that kind of fell through the floor, one would say, right? All right, so, but let's talk about it. HDFC Bank since mid-January down about 13% despite the gain in trade yesterday. It was a bit of a relief for those people that are betting on the bank for the long term. And we're going to talk about whether or not certain aspects that have come through source-based conversations that Vishwanath Nair has had, whether that's going to alleviate some of that selling pressure, and in fact whether or not the stock can gain at all from this point. We'll also talk about what the management's role in all of this has been, and Sajith will bring some perspective into that. But Vishy, let's talk about the source-based information that you've picked up first.
Right, Alex. So what we understand through speaking to some sources who are very close to this entire decision-making process, the idea is that the bank is going to look at selling some of the assets which are linked to high-cost borrowings. Now, you have to remember that for HDFC Bank, the high-cost borrowings were the biggest pain point during the third quarter. From 8% of total liabilities, because of the merger, that portion, the borrowings have risen to about 21%. This was primarily because HDFC Limited had a lot of borrowings on its balance sheet, which transferred to HDFC Bank. Now, what the management intends to do is sell some of these high-cost assets, and then once you sell those assets, then obviously you can start releasing those high-cost borrowings, and that brings down the cost. It also brings down the loan-deposit ratio, which was another pain point for HDFC Bank. 110% on the loan-deposit ratio. So once you start reducing the loan portion of that equation, the ratio starts making a little more sense. So currently, the difference between the advances and deposits is about 2.5 lakh crore. Right. During the merger, the bank got a lot of builder loans from HDFC Limited. One would estimate that about 80-85% of HDFC Limited's loan book was individual home loans. Sure. The remaining 15 to 20% is coming from the developer loans, yeah, which is the problem area. So once you start selling down those loans, then you can ease out that borrowing portion. The bank also intends to keep churning out PSL compliant loans, priority sector lending, because a bank is required to have 40% of its total credit in priority sector. So that they will continue to generate as well as hold. For the other loans, they will generate and they will look to sell down because it makes more sense to give it to the market and retain maybe only the management fee portion of that deal rather than keeping the asset on your book and, of course, failing on the LDR portion.
What is the implication, if at all, of selling these loans in the securitization market on the profitability of the bank?
It doesn't really change much because what you lose out on the margin front of the deal, you make on the management fee. So that sort of covers it balances things out.
But and just to follow up before I go to Sajid on his view on the management, there is a considerable gap, as you've pointed out, 2.5 lakh crore. And earlier we were talking about how deposit growth has not come through.
Yeah.
40,000 odd crore was the increase in the third quarter.
During the third quarter, yes.
Which is kind of lower than what they've achieved in the past, fair enough. But even with the sell down and release of some of those deposits, high cost deposits, will they be able to bridge that gap?
So what the bank intends to focus on is growing the deposit base. Now that is part of the core decision-making process. Now, what has happened during the October-December quarter, unfortunately, the bank went through a leadership reshuffle of sort, right? Under Shashidhar Jagdishan, there were multiple business leaders, and as part of his management philosophy, he has reshuffled that portfolio. So new people came in who took some time to just adjust to the business. Now that's the reasoning that is coming through from my sources. But what is also part of the discussion is also that the pie for deposits has come down. The incremental deposit growth in the system is slower. Right. And HDFC Bank continues to hold about 18 to 20% of that incremental deposit share, which is healthy. But since the outstanding number has come down, that 80-20% is also coming down. So 1.5 lakh crore, which they reported in the previous quarters, may not happen right away.
Sure.
But this 40,000 crore is probably an outlier, and it is likely to steadily go up.
Okay. So a combination of those two factors. Yeah. Sajid, I kind of know what you're going to talk about, and it's not a pretty picture, right? Because one has to look at the role of the management in managing expectations and also in including the investor base in what their vision going forward is. There are certain issues that they knew would crop up. I don't think that a gap in deposits and lending is something that a bank does not get aware of in the process of merging. What is the point that you're making?
When there's a promoter-owned company and you have a professional management, the management is reporting to the promoter, and he's responsible for whatever it is, and the promoter is taking the fall for it. In a bank which does not have an unidentified promoter, it is the management or the MD and CEO whose responsibility is to answer to the shareholders, simple, directly. You have a mechanism in the market where you give at the end of the quarter an advance notification to the market and to the shareholders about how the quarter went by, what are the ifs and buts in the quarter. If there is any surprises, you bring in that communication. The communication was not there. Now, if some of the sources are saying that, some of the sell-side analysts may have put a sell, there were institutions like hedge funds who sell. The thing is that share price was punished because of information asymmetry, which is there. Now, our markets thrive on information asymmetry, and they made gains on that.
And the institutions that sold were not obliged to hold.
They are there to make profit, not to manage support the management. They are here. Their KRAs are to make profit on the investments.
Right.
So whether it's in a hedge fund or it's any other fund which is shorting or are doing an arbitrage on that information asymmetry and getting a gain of 13-14%. It's their right to do it, and there's nothing wrong in it, in this market to do it. Market punishes and rewards based on information asymmetry. A management which is very good in communicating, there's a reward that comes in because we're in form of a premium coming into the stock. If you're poor in communicating, you're punished in that. We've seen in some of the IT companies where the management have been upfront in doing it. Despite negative news, despite anything, we've seen stocks going up. There is a valuation there. Of course, the PE ratios may have fallen a little bit because of that. But there isn't this kind of surprise that is coming in. Market does not like surprises. And if you create an information asymmetry or a gap between what you want, what you promised and what you delivered, then there is a problem for that bank or the company.
It's a harsh lesson, I would think.
Can I just add one point on this? So we have to remember that for a lot of the private banking ecosystem, the last 5 years, you've seen big management changes.
Yes.
Now, typically, associated with management changes is something known as kitchen sinking.
Yes.
Right? When the new management comes in, you see a big dip in the asset quality, you see a big dip in profitability, and then things start to take over. In the last round of management changes, that has not really happened. So there is a little bit of like what exactly is happening with this management change and what is the surprise element. And if information asymmetry, as Sajid puts it, is the problem, then people just latch on to that, and that becomes the
just
trigger.
look at it, right? It took them 7 days to come out with some kind of information, and that too on a source-based thing to all platforms there. 7 days when you have seen 32,000 crores of delivery turnover happening on that stock.
Yeah.
Yes.
And there is a churn still going on because you have 50% or more than 50% of your investors who are foreign investors, and they're not happy in any way.
And you
with
can
the kind
call
of
it therefore a failure in
It
communication.
is a failure. Means if you were in the US, you would have been questioned by the board or the shareholders, saying that what are you doing?
So. Okay, so we've established certain aspects. The question is whether this incremental information is going to be enough to stem the tide that we've seen so far. Yesterday, you saw a bit of a breather in the price of HDFC Bank. We'll see soon enough what the reaction to the latest update is. Do stay tuned. We've got lots to talk about over the course of the next half an hour, setting you up for trade.
Welcome back. You're watching India Market Open. GIFT Nifty is indicating to a flat to lower start this morning, but we've got Agam standing by as always to take us to the F&O picture. Agam, sharp recovery, or rather short covering led rally in the second half of trade yesterday on the Nifty, but no participation from Bank Nifty. Is that going to change this morning? You think Bank Nifty is going to pull through?
Spot on, Samina. That's the big question, isn't it? While the Nifty did see a strength yesterday, the Bank Nifty in fact had an extremely choppy session, and it was in fact lagging through the course of the latter half. And we did see a lot of strength in the first half, but a lot of that strength was given away. The question really is that can some amount of positive news from HDFC Bank trigger that further much warranted short covering? That's a wait and watch. But as far as the Nifty is concerned, a 1% up move, rollovers are now picking up around 63% odd as far as the Nifty is concerned. This is as far as Jan futures go, where, mind you, it's gone into a premium against a discount from day before. And the February futures, of course, naturally seeing a little more traction now that we are in expiry. Let's talk about the Bank Nifty. This was a curious case, an extremely choppy one. While we did see the Bank Nifty, open in the red, eventually move to the high by gaining as much as 1% at one point in time, and then eventually coming off and settling at around 45,000. It certainly was a confusing one for many traders. That said, at least as far as your open interest in the February futures go, it's picking up again. The question really is this towards shorts? That's something that we will get an answer towards over the course of the next few days. But in terms of how things are stacking up as far as options go, at least in terms of the Nifty, in today's day of trade, we are keeping an eye on 21,500. Now, that's roundabout where the Nifty is. And while based on max OI, you have a very broad range of 1,000 points, one can only hope that the Nifty doesn't gyrate that much. But we're still keeping an eye on 21,700 and on the higher end, and 21,300 on the lower end. That's a rough 400-point range we're expecting the Nifty to move within. And as far as the Bank Nifty is concerned, once again, things are a bit trickier here, but we are keeping an eye on 45,500. That's where the Bank Nifty went up all the way up to and then came off substantially. So it is going to serve as a little bit of a hurdle in today's day of trade. And of course, on the lower end, we're keeping an eye on 45,000, where we do have a little more accumulation as far as puts are concerned. So we're going to keep an eye on a whole host of these levels as we move into trade today, which is also the monthly futures expiry. So a lot of these factors will play out, and it could very likely be another choppy session. You never know. But what are our market experts making of these trends, and are they looking at a bout of increased volatility? Let's find out. We have Milan Vaishnav. He's of Gemstone Research, who's joining us on the show right now. Milan, good morning, and thanks for joining in. Your view on the benchmarks, especially given the kind of divergence that we've seen in the Nifty and the Bank Nifty yesterday?
Yeah, well, good morning, Agam. I'm seeing many things which are likely to happen on Nifty. First, to begin with, I'm watching 21,350 to 400 levels very keenly, because that's where the puts were being constantly written while the markets were recovering in the last hour and a half of the trade. So if the 21,350 to 400 zone is defended, we might see Nifty advancing towards 21,500 levels. Now, 21,500 is also the place where some incremental call writing was also seen yesterday. And if 21,500 is taken out, then 21,600 plus levels would be very easy to come by, because 21,650 is where the 20-day moving average is. So the moral of the long story is that 21,350 to 400 zone needs to be defended. If that happens, then we are looking at 21,500 levels and higher on Nifty. Another thing that I'm watching is that if Nifty stays stable and showing even the mildest signs of some extension of the recovery that we saw yesterday, I also expect Nifty Bank to play a catch-up, because it has bounced back, rebounded from its 200-day moving average and it's a couple of 100 points below the 100 DMA, which is at 45,336. So 45,300, 400 levels is what I will expect on Bank Nifty if Nifty stays even a bit stable right now.
Right. Milan, based on that, how are you playing and placing bets on the Nifty at the moment?
Again, my bets will focus on options which is expiring on February 8. I will skip today's expiry, of course, there's no point. I will also skip the first Feb expiry because on that day we'll be having vote on account. It's not going to be a full-fledged union budget, but still, markets are likely to stay equally volatile on Feb 1st as well, which also happens to be Thursday. So what I expect that we will see Nifty quite choppy in a very broad range until Feb 1st. It will go up and down, stay in a wide trading range, but after 1st, it is likely to catch up a sharp, definite trend on either side. So rather than deciding on which direction of the trend it will take, I would like to rather keep that options open, and I have gone for a long straddle this time. I will be buying 21,500 call and put, both of same strike price, call and put of same strike price, expiring February 8th. And the total premium that I will pay would be around 525 rupees, that is 26,250, and that would be the maximum loss that one will see in this trade. Now, what I'm expecting is that once we are through this couple of days of choppiness, markets will pick up a sharp, definite direction on either side after 1st of Feb, and that's where this trade will start playing out. We will have break-even on 20,975 on the lower side and 22,025 on the higher side. This is a limited loss and unlimited profit strategy. The loss is limited to the maximum amount of the premium that we have paid.
Okay, so very interesting strategy here. You're playing the long straddle because where we don't really know what direction the Nifty is going to take. We, in fact, go ahead and buy a call as well as a put. A sharp move towards any direction is likely to lead to profitability. Of course, on the other hand, the villain in this case, in this particular strategy, will be time decay. But, not much to worry for otherwise, especially given the fact that we are seeing a lot of volatility, a lot of choppiness as far as markets are concerned. But, Milan, coming back to a stock that you also have on your radar. I believe it's Hindustan Copper. Can you take us through that one as well?
Yeah, Hindustan Copper is something that I'm looking at on the stock specific view. But before that, I would also like to add one point to the long straddle that I suggested, that keeping the time decaying view, that is the main reason that I've kept expiry further 1 week away, so that one gets enough time to survive through first pack and then benefit from the sharp move that the markets might take on either side. Now, coming back to stock, I have a stock specific pick on Hindustan Copper. This can be bought above 274 with the target of 295 and stop loss of 258. Now, this is purely a equity investment play. It's not an FNO stock, so one will have to buy in the cash segment.
Okay, there you have it. That's your view on Hindustan Copper. We'll be keeping an eye on that one as well. Milan, on that note, would like to thank you for joining us and taking us through your views on the markets and giving us the trading ideas. And with that, it's over to you, Tamanna.
All right, so we're set up for a very interesting day today. Thank you for that, Agam. But meanwhile, let's keep the focus on Tech Mahindra. A decent quarter with a rise in revenue and new deals with trajectory moderated, though. Tushar is joining us. He's been tracking those numbers. You listened into what the management commentary is and what is expected. Tushar, we have a whole slew of brokerage notes as well this morning on Tech Mahindra. What's the word out there on the numbers?
Yeah, so good morning, Tamanna, good morning, Samina and Agam. So if you look at the earnings, and it should flash on your screens right now, revenue rose after 2 quarters of declines, and there was some improvement in both the EBIT of the profitability numbers as well as the net profit numbers from the lows that we saw in Q2. So other key highlights: dollar revenue is up, in constant currency is also up. Attrition rate has eased to 10%, but there was a decline in headcount. But what brokers are saying is a mixed bag. What they are getting the sense is that the management is looking at a more long-term growth, more long-term sustainable growth instead of quick fixes. So we have to also remember the fact that this is the first earnings call by the new CEO Mohit Joshi. So he's been about 35 days into the job, and his focus, given the BFSI veteran that he is to actually fire on all cylinders. So we spoke to them yesterday, and he said that he has pointed to a dichotomy. There's manufacturing and enterprise income growing, and there's decline in the telecom, which is Tech Mahindra's breadwinner, and BFSI is shrinking. Now, he would want all of them to power through in the next 1 year. But the problem with that he'll face is the demand scenario. While it is better than 6 months ago, but there are no green shoots visible so far. Remember, clients have set up their budgets, so they will be looking at spending those for the next year. But there's still no green shoots available as for what Mr. Joshi said. The margin revival is the focus area for the company. It's at about right now 5.36%. It's nowhere close to the top tier peers. But what the company wants to do is invest in the long-term sustainable growth and not any quick fixes just to shore up profitability for the next 1 year. But if given a choice, Mohit Joshi said that he will actually focus on profitability and not growth. In summary, his first job would be to first steady the ship out of the troubled waters and then go for the proverbial land, so to speak.
Tushar, very quickly. So therefore, no margin revival as a quick fix. Therefore, no immediate triggers. Our brokerage is concerned about that? What has happened post results? So
brokerages are cognizant of the fact that Mr. Mohit Joshi is looking at a long-term growth. That's why their picture is also mixed. So Citi is saying has a sell rating on the stock. Jefferies is maintaining an underperform. Nirmal Bang is saying accumulate. HSBC is saying a hold. So we see a mixed picture. So depending upon what brokerage is looking at Tech Mahindra from what angle? Are they looking at the next 1 year picture, or are they going to give Mr. Joshi some time to deliver the sustainable returns or sustainable growth that he's promising?
Okay. Well, Tushar, thanks for putting that into perspective. It'll be lovely to maybe at the end of the week or something get a sense of now that the top 6 IT names are out, how have they performed? And Tech Mahindra clearly needs some more time from what Tushar is telling us. So that's one. And in a moment from now, we'll get in our guest to kind of talk about this as well. If we have Kush Bohra, we should try and go to him, or else let's get in Varsha, my colleague, to talk about some of the other companies which reported their third quarter earnings as well. Varsha, there is a pharma company, Laurus, which came in during market as in the fag end. Talk about that and talk about some others as well.
Yes, good morning, Niraj. So starting with Laurus Labs, if you see profit has missed estimates. The stress in API business and CDMO synthesis lead to weakness in the quarter. Also, if you see, there was strong CDMO business and API business in the last quarter. Remember, API business contributes to nearly half of the overall top line, and also EBITDA margin compressed due to higher spends on growth projects. Then we have CET, where margins and PATs were above estimates. Profits have jumped over 5x on the back of strong replacement demand and international growth. Also, if you see, company had experienced margin pressure due to steep increase in raw material prices in past quarters. But now, if you see, raw material costs have decreased in this quarter, resulting in improved gross margin and a surge in PAT. Also, company has approved a capex of almost 525 crore. Then lastly, we have Balkrishna Industries, where margins have nearly doubled. Profits have grown over 2x. This was led by volume growth, and also margins were up due to lower freight and forwarding costs, and also lower other expenses.
Okay. We'll watch out for some of these names as well. It'll be interesting. So viewers, just remember, for all these companies that we're talking about, be it Birlasoft, who will talk to us at 9:45, Laurus Labs will talk to us at 10:05, Tata Steel talk to us at 1:30, CET probably talk to us at 10:35 or 10:40. So you'll hear all of these managements on NDTV Profit today. Let's get in Kush Bohra, founder at kushbohra.com, and Sunny Agarwal, head of fundamental equity research at Sbicap Securities, with their views as well. Before we get to a stock ideas, Kush, just a quick word on how do you see the indices, predominantly the Bank Nifty, because one would have hoped that with the slight resurgence in HDFC Bank, the Bank Nifty would see some upticks, but ICICI Bank thwarted that.
Hi, first up, a very good morning to you and to all the viewers, and wishing everyone a very happy Republic Day in advance. Let's just take a step back. Sometimes when we get too close to the action is when the view actually gets a little muddled. starting January, late December, everyone would have said that January is going to be a weakish kind of a month. We might have a negative close, and we're staring at that, right? So if we take it from an eagle's eye view, then I think January has actually not been so bad. As I said, when you get into the details, that's when it gets a little tricky. But I don't think January has been as bad as it could have been otherwise. So from my perspective, it's turning out to be a decent enough month. And as I've said, time and again, we're setting up for a fabulous February and March. Now, that said, Nifty has shown some sort of strength, not encouraging enough to say go out and take longs. In fact, 21,500, 550 will be the level to watch out for today. I don't see the expiry happening, beyond that, at least not, by a great deal. Nifty, Bank Nifty, also very similar view. I think it was a relief rally just ahead of the expiry that we saw yesterday. I don't call it out of the woods yet. In fact, 45,000 is the level that we're watching for. So there could be a muted action that we'll see perhaps on Bank Nifty today. 45,000 will be the pivotal level, give or take 200 points is where the expiry should be. Now, HDFC Bank has gone into deep oversold territories and we're seeing a bit of a rebound from there. So there could be some sort of a consolidation move that we'll see both on the Bank Nifty and HDFC Bank. But even if that happens, like we saw yesterday, Nifty will have enough and more steam to perhaps make a higher move. Not today, perhaps starting next week when the new expiry and the new derivative series starts.
Sunny also joins us to talk to us about the fundamental view on the market. Sunny, before I talk about the benchmark independently, I want to get a view on HDFC Bank. Do you think it's found a bottom? Fundamentally, is a risk reward now in favor of HDFC Bank at these levels? Because a very smart pullback happened from levels of 1380 yesterday.
Yeah, good morning. Definitely HDFC Bank, we all know that results were slightly tepid. And now it is a clear writing on the wall that it will take at least 2 quarters for the bank to recoup its NIM margin once the merger banks are behind, and then post that we may see margin bottoming out. And then in terms of growth, anyway, HDFC Bank has went on record to say that they can add one more HDFC Bank in a span of next 4 years. But having said that, from a short-term perspective, obviously the leadership is shifting towards other banks like ICICI Bank, Axis, for that matter. So if somebody is a short to medium-term investor, obviously he should be, he will be focusing on a bank which are outperforming, relative outperformer like ICICI and Axis. And somebody want to bet on HDFC Bank, then I think the approach is a gradual deployment of capital over the period of next 3 to 6 months, and then ride that story once the merger banks are behind for next 3 to 4 years. So definitely on valuation front, HDFC Bank is offering a lot of comfort. But in terms of outperformance, right now there is a clear shift in leadership as far as private banking sector is concerned towards ICICI and Axis Bank.
Kush, very quickly, your picks for this morning. Can you hear me, Kush?
I can, yeah. So,
yeah. Your picks for this morning, very quickly.
A couple of them from the F&O space. Tata's power continues to build momentum. So 365, 372 are the targets that we're looking at on the upside. 350 is where I would place my stop loss. From the cash segment, there's a breakout candidate, Zydus Life Sciences. 770 and 790 are the levels that we're looking at, and 738 is where I would place my stop loss.
All right. So Tata Power and Zydus Life on Kush's radar. Very quickly, let me go across to Mahima. There are so many stocks that are buzzing this morning. She's talking about DLF, Chalet and Realtel. What's the news there, Mahima? All the numbers that have been announced post-market, are there hits or misses?
Well, Tamanna, in case of DLF, profits, revenue and margins have missed estimates. The board approved the sale of its office building DCCDL for 825 crores and pre-sales number has been recorded at 13,316 crore in 9 months FY24. So this stock could probably see some kind of pressure. If we talk about Chalet Hotels, in terms of consolidated year-on-year, strong numbers with reference to revenue and margins. However, the profit has taken a hit because the company has reversed the provision of interest midst of cancellation of flats for a case that they were facing. In terms of Railtel, margins have shrunk, profits are down this quarter. The order book stands strong. The stock has seen an up move of 30% in the last month. However, today it could see some kind of pressure, and there has been increase in terms of project expenses and a tax in respect to last year, which has been provided for in this quarter, and which is why the net profit is down. So these are the reasons why these stocks will be in focus today.
All right. So let me just get a quick call from Kush on any of these counters. Railtel, a hot stock, but you've seen margins and profits compressed. What is it looking like on the charts? And DLF as well.
Well, the entire railway pack has, had rather gone into an overbought territory and, perhaps cooling off from there. It's just a day's dip, but despite that, they look actually a little attractive from a trading perspective now because the dip was indeed sharp. So I wouldn't, be too averse to buying a call from here on. 410 and 425 are the near-term levels that I'm looking at, and on the downside, 385 is a strong stop loss on Railtel. As far as DLF goes, it's gone below its 20-day moving average, so a bit of a cause of concern. Nothing major, but just a level to monitor on will be 765. So once it crosses that, it'll again go back into the uptrend that it had going for itself for a while now. So above 765 is when I would consider a positive trade. Up until then, just keep it on the wait and watch list.
Right. Stay with us, gentlemen. We're gearing up for pre-open trade. It's expected to be a flat to lower start. We'll take a break. We'll come back. Lots of earnings and stock conversations to focus on, so stay tuned.
All right, back with India Market Open right here on NDTV Profit. We're trying to talk about all the stocks which will matter this morning. Watch out for metals and watch out for oil and gas. Now, I want to highlight Petronet LNG because of a note that Citigroup has put out. They advise booking profits out of Petronet LNG and moving into IGL. Now, the rationale seems to be that because there has been a 30% or 32% rise in Petronet LNG in the recent times, it discounts any or all kind of positives that could have come about. They have a negative catalyst watch with the target price of 185, of course, but they have a negative catalyst watch as well. And more importantly, they are saying that the Qatar deal, which is being spoken about, is well discounted and actually might bring in some bit of uncertainty as well. Sunny, come in on Petronet LNG. Has had a good move, more so triggered by this India-Qatar agreement as well. Has had a really good rally in the recent past. Is it a stock that you would be recommending booking profits, or would you stay long if you were long?
Niraj, I would like to again like to book a profit over here because already the positives are in the price and we have seen a very healthy rally in Petronet LNG. In fact, one stock which I like from the same industry is Mahanagar Gas Limited. So company has reported very fabulous set of number yesterday, day before yesterday, and basically again one of the key beneficiary of lower gas prices in medium to long term, trading at a very reasonable valuation, 13-14 times. The event of results are behind us, and at the same time, the segment which MGL caters to PNG and CNG, it's a very stable segment, and where we are seeing a demand increasing consistently either from household or by the increasing use of CNG vehicle. So MGL is a company which I would like to bet my money on from oil and gas sector.
Right, we've got 2 minutes to go as we're gearing up for trade. Kunal, do you want to comment on metals? Kush, pardon me, would you like to comment on metals? Any specific metal stocks that could extend yesterday's rally into today's trade?
Hindalco's one stock that is on my radar had a good move yesterday, could continue, on the upside. Tata Steel, I suppose, could also extend the run that we've been seeing. So I think these are the two picks that I'd have. The preferred one obviously remains, Hindalco has taken support near its, a 50-day moving average and showing signs of rebound. So 580 and 600 are the levels that I'll watch for on the upside. So Hindalco and Tata Steel are the two stocks that I'll have on my radar.
Alco and Tata Steel, of course, Tata Steel also earnings focus will be one that you want to watch out for. Numbers, remember, were slightly below what the street was expecting. We will talk about that in a little more detail as we go along through the show. 30 seconds to go as we gear up for pre-open trade. Remember, it was the second half of trade yesterday that saw short covering-led rally on D Street. Still not a very convincing place for the Nifty to be in. Bank Nifty, remember, hasn't lent its support. It would be interesting to see if it actually comes through in today's day of trade. HDFC Bank was the only gainer yesterday. Metals from the Bank Nifty space. Metals did quite well. Oil and gas also had a good run. Today, the day could belong to mid-cap IT, auto ancillary, auto stocks, metals again. And it's expected to be a slightly lower start. At least that's what we picked up in terms of the implied Nifty. We'll come back and take a check of that in a few minutes. But, just for the sake of just checking into what's happening, if I can pull up HDFC Bank, Tech Mahindra, Tata Steel, those are some of the counters that will report or react to earnings. Bajaj Auto, TVS Motors are the few names. Again, a bad day on HDFC Bank, at least in terms of pre-open trade. 2.5% cut is what it is showing. Sunny, we've talked about a whole bunch of names already, but I'm extending that rail conversation as well that you had, with us. What are you doing with some of these rail stocks? Do you feel like this theme could continue into the next quarter? Because I'm guessing after the sharp rally some of this railway stocks or defense stocks have seen, it's now time to pick the next trend, I'd imagine. Would you pick a new trend, or would you stick with what's working, which is rail, defense, and continue buying those? And if yes, what is it that you'd buy?
So we have seen a very sharp rally as far as railway stocks are concerned. And what I feel is that right now, it's in terms of stock price action, I think it is a time for consolidation and let the earning catch up. Maybe for next 2 to 3 months, or maybe quarter or two, Street would like to see the earning growth. Let the order book materialize into the revenue and bottom line. So what I feel is that right now, railway, again, medium to long term outlook continue to remain positive, but the approach has to be again buy on deep rather than buying at a current valuation or at current market price. So I feel a positive factor for next 6 to 12 months are already in the price. The next kicker can be any incremental big orders from government of India. So that can be the next kicker. But having said that, I would not like to deploy my fresh money at a current juncture. Buy on deep is the strategy which I would like to use for railway counter. The new theme based on the government capex is the recently announced push for renewable, especially in the solar side. So that is the one sector which I feel is still there is still an opportunity over there. At the same time, what I feel is that that electric vehicle EV bus segment is a segment where we may see some positive development on. So companies like Olectra, JBM Auto, or for that matter, Ashok Leyland. So we all knew that last year when Honorable Prime Minister Narendra Modi ji were in US, so there was a deal between India and US for funding of electric vehicle buses in India, and we are expecting some positive development on that front. And post that we may see some big order flow for EV electric buses for all these companies. So that is one sector we are bullish on.
That's a great point. Thank you so much, Sunny, for staying with us this morning, and especially the focus on the renewables and clean energy push. Kush, please do stay on just for a bit. We want to see how that opening works out. I just want to add a bit to what Sunny is saying as I welcome Rahul Arora, CEO at Nirmal Bang Institutional Equities. Very good morning, Rahul. Great to have you on this show. And let's take that conversation forward. Yesterday at the cabinet briefing, this coal gasification scheme that was announced is an important one. It essentially allows you to turn coal into synthetic gas, cleaner fuel, and a big government push, huge amounts being spent, Coal India, GAIL, BHEL, some of them to push through. So let me start right with that, Rahul. Is renewable/clean energy a big theme that you're looking at? Do you think there's already a lot of run-up, or is that going to be top of the mind, especially ahead of 1st Feb?
Morning, Tamanna. Thank you so much for having me on your show. Look, a lot of these are very long, drawn-out projects, right? I mean, just compare it to electric vehicles, right? Where we should have been and where we are today. So I think the steps are in the right direction, but there are not too many listed plays by which you can look at playing these. I think these are structurally very good decisions, but I think you'll find more traction on these a few years down the line. I mean, take a look at ethanol blending as well, right? I mean, there's been a lot of talk about where it should have been vis-a-vis where it is. So I think on a headline, these things sound very good, but I think, you have a few names that you can really play these through. But like you were discussing with some of your other guests, I think the problem in this market, Tamanna, is when you have a very limited supply of stocks to play a very large theme, that trade gets so crowded so soon that valuations stop making sense. And then you probably have to just play out a few years of very moderate returns. You've seen that with defense. You've seen that with railways. You saw that with other PSU financing stocks as well. So I think there are other ways also. I mean, there's, say, for example, Triveni Turbines, right? A small cap name, which is also into biomass, waste heat recovery. They're talking a lot about cogen. So there are a few of these names, but like I said, I think these are more headlines for now than genuine plays for companies to make them a meaningful proportion of their current revenue. So a 5-7 year theme, maybe even longer, but it's great to be excited from a country standpoint, but I'm not sure how much of this really translates into stock.
Would you say the same for the railway story?
Absolutely.
It's the same story, right? Long-term projects. But look at the run-up and the continuing run-up.
No, so let me give you a parallel example, right? When COVID started and this entire notion of China plus one became a very big fact to talk about, remember what happened to the chemical stocks? I think the chemical stocks went up 4-5x in a matter of 6 months. And then what's happened? 3 years returns are either flat to negative. And I think that's probably likely. See, I'll tell you what happens, Tamanna. You can't fudge earnings, right? So either liquidity takes the price up, which is basically you're exaggerating your price to earnings multiple, or then you start valuing companies on FY 26, 27, or you start doing a discounted cash flow. But if you're squarely going to be valuing a company on EBITDA or earnings, there is only a finite amount of upside you can give. And I think if you look at any stock in the market today, not just some of these new age stocks or the newly discovered sectors, I don't think any sell side in India is valuing any company on FY25 anymore. That itself tells you, see, the market itself is trading at one standard or I think 1.5 standard deviation over mean over its long-term average. So it's not a cheap market. You're buying an expensive market. And on top of that, if you want to come in and buy the most expensive stocks in that expensive market, then you're going to have very tepid to moderate returns going forward. So I know it's very easy to get on, a moving train because it seems like it's going in the right direction at the right speed. But I would exercise caution in a lot of these names. Like I said, I mean, these are fantastic headlines, but to actually monetize them through stock prices may be a slightly more challenging at this point.
You can't fudge earnings. Interesting. Rahul, Ramalinga Raju might have a different take on that, but good morning. Thanks for joining in today. The aspect that has stood out, Rahul, this quarter, has been the kind of numbers that some of the two-wheeler companies or auto companies have put out in general, auto anchs as well. Any thoughts on what stood out for you guys at Nirmal Bang when it comes to earnings in the auto pack?
So, Niraj, on a lighter note, we don't discuss Satyam anymore, right? So it met its fate, and I don't think there are too many companies in India that have gone down that road. Yeah, I think autos, Niraj, has been an interesting play. I think, two-wheelers, by and large, volume growth is sanguine. I think the way we're looking at the economy over the next 12 to 15 months is that the bottom of the pyramid in India is still undergoing some pressure. And I think to that extent, I think whatever the government of India can do to lend support to the bottom of the pyramid will be welcome. And in that, I think it will help a lot of the entry segment motorcycles, so to speak. In that, I think Hero MotoCorp will probably be a big beneficiary. I think the dividend yield on Hero is also pretty strong. If I'm not mistaken, it's almost a 3.5% dividend yield company. So I'm fairly comfortable playing the valuations. If you look at Bajaj Auto, a large part of the earnings this quarter has come in from a margin improvement. The question is how much of this margin improvement actually sustains going forward? Because if you remember when TVS used to be a 30 or 40 rupee stock, the hope then was that this would go to a 10% margin business. And look at what's happened to TVS as a result. And the question is, at a 10-11% margin, can TVS give you much more from here after being, a 50-100 bagger that it's been over the last 10 years? So I think, within the overall cycle, I think my pecking order would still probably be more towards commercial vehicles at this point. I think there I would still play through Ashok Leyland. There is a defense angle also, which is actually playing out pretty well. Subsequent to that, I'd probably say two-wheelers and maybe passenger vehicles as a third order. Because I think if you're looking at passenger vehicles as well, Niraj, the entry level is struggling, but the premium end is doing well. But when you're playing premium, you're playing predominantly realizations and you're not playing volume growth that much. So I think CVs and two-wheelers would probably be the place where we would stick our necks out. And within that, Ashok Leyland, Bajaj Auto and a Hero MotoCorp is something that we would like.
Hi, Rahul. This is Samina as well joining in. And I want to extend that conversation from auto to auto ancillary. Now, we've seen numbers from SEAT and Balakrishna, a clear beat in terms of first cuts at least. Could that be a way to play the auto pack, go into the ancillary route, you think? And if yes, any preferred players there?
Morning, Samina. So I think for a lot of the tire manufacturers, especially, I think CapEx is done. And I think replacement cycle is going to kick in a fairly material way. So you're going to see incremental upsides on return on capital employed. And I think you're going to definitely see cash flows improve for not just SEAT. I think it will hold true for Apollo and the others as well. In the case of BKT, obviously the capex intensity is a little bit higher, especially on what they're doing on the carbon side. So I think the ROC expansion may not be as strong as you probably see in some of their other peers. But being a market leader in the OHT segment and, of course, tapping the export market in a very material way, it's been a great stock over the years. It's been a little volatile over the last 18 months, I understand. But I think, the point I was making to Niraj about CVs and two-wheelers, ANKS is a very good way to play it. And apart from the names that you mentioned, I could throw in a Jamna Auto there as well, which is almost, a 25-27% ROE, ROC business. Margins north of 20%, and their key clientele being Tata Motors and Ashok Leyland. So I think to that extent, there is certainly juice left in the auto component names. But, in names like SEAT, MRF, Apollo, they've had such a good run off late there. But there again, my issue will become, challenges on valuations. But I think auto ANKS vis-a-vis autos is definitely the better trade to make.
I'm going to digress. We've got 3 minutes to go before market opening, but I can't not ask you about HDFC Bank before the markets open this morning. How do you feel about this one? The house is divided, whether they see value in this one, they don't. So far, the returns have been fixed deposit returns in the last 3 years, if that, maybe not even that anymore, actually. How would you approach HDFC Bank? Would you give it the benefit of doubt, buy it at a good price, or avoid it till you see some clarity emerging in terms of leadership at least?
So, they say you buy good companies in bad times, and I think this is the chance of a lifetime that HDFC Bank is giving you. I think you need to go in there lock, stock and barrel and start buying. You don't question these companies. I think, the biggest challenge over the years, Samina, has been when you look at companies like Asian Paints, HDFC Bank, Bajaj Finance, etc., people always wait for corrections and they never happen. And I think this is, if you are a long-term investor, there is nothing wrong with the bank. There is a transient merger impact, which everybody knows about. It's having an impact on the numbers. As you rightly pointed out, it's been a fixed deposit kind of return. It's had a time and price correction. But can HDFC Bank be the next HDFC Bank? And this is not my original phrase. This is actually a phrase that Ruxal Shroff had made a few years back when he was heading Jardine Fleming at a CFA conference. He said, yes, HDFC Bank can be the next HDFC Bank. So I think you're getting it at rock bottom valuations. This is a bank that used to go at 4 or 5 price to book. It is still going to give you a 15 to 18% net interest income and profit growth over a decadal period. No reason not to buy this bank.
Would you extend that to some of the other names in the private banking space, Rahul? Because it seems to be sort of a fear or a mood, down mood that has spread. The inherent concern about expensive cost of funds, slowing deposit growth, that seems to be a problem that's not going away anytime soon. And that doesn't concern you?
So I think largely, Tamanna, if you look at the net interest margins of banks, they've been under pressure for a while now. And at the short end, I'm not talking about the long end. Sorry. At the short end, if you've seen, deposit rates are continuing to rise. And I think you're going to see a challenge on net interest margins for the next 2 quarters as well. But the question is, as 2024 progresses, when you're going to have rate cuts, what happens then? I think a lot of this may actually reverse. And if you have a system-wide credit growth of 15% plus, it's remarkable what can actually be achieved by some of these banks. So look at ICICI Bank, right? It's been 3 or 4 quarters in a row where they've actually beaten expectations or met expectations. The stock hasn't done much. IndusInd Bank also has not been doing too badly. So I would certainly look at nibbling into some of these large private sector names, because remember, like I said in my opening answer as well, a lot of the trade has been concentrated towards PSUs. So I think some of that moving back to private, larger private banks, I can certainly see that happening.
Got it. Okay, Rahul, we'll leave it at that. Thanks so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time. Kush, stay on. We'll just come to you now post-market open, because just 18 seconds away from market open. So we'll take in your opening thoughts immediately post. We've marked how some of these individual stocks have done on the eve of Republic Day. But 7 seconds left, and we'll likely start off flattish, but the individual components would be in focus. I'll watch out for Hindalco very, very closely. But here's the first traits. Flat as flat can be. As Navjot Singh Sidhu used to say, flat as a pancake. Bring up the mid-cap, small caps, or the Bank Nifty as well. Actually, yeah, the Bank Nifty is not a bad idea. Again, flattish move really. Would be interesting to see the mix between HDFC and ICICI Bank. Mid-caps, well, hardly anything there. I doubt small caps are doing materially different. Actually, they are. Sorry. 0.5% higher. Not bad. Let's see if this lasts. Bring up the heat map and see if metals are still doing okay. The top gainer, though, is Bajaj Auto, or 2% higher. So strong show there. Interestingly, Coal India, a bunch of news on that stock. Not as strong a reaction, but 1% nevertheless for a stock which has done well in the recent past. Not a bad ploy. Adani Port, yesterday amongst the top losers, today gains a little bit. There is a very strong opinion piece by Gautam Adani in the Times of India talking about the 1 year since the Hindenburg saga. I don't know if it brings the other Adani Group stocks. Well, on the index at least, Adani Enterprises too, up about 0.5%. So interesting moves there. SBI and Kotak Bank are amongst the others. It's evenly spread between the reds and the green, maybe a bit more green, but almost 50-50. What's not doing well? Tech Mahindra on expected lines down 5%. HCL Tech about 1.25%. So Techem is something that we'll ask Kush Bohra post we finish the market check. Tata Steel marginally lower, but I don't see a Hindalco in the top movers list. So clearly the Rusal sanctions conversation is not having a material impact on the aluminum stocks for now. Net, a flattish start with Techem clearly taking the lead in terms of the losers.
Niraj, that pancakes doesn't sound half as bad in a market which has been very, very volatile. So it's okay. Not before a long weekend, also expected perhaps. No one wants to make any big moves. But a few stocks that are on our radar. And of course, the big news push seems to be from quarterly numbers. The market punishing and rewarding numbers as they see it. Birlasoft, which is what we'll talk about first. The numbers actually looking good on the face of it. They've done well in a tough quarter, but not too much response on that stock this morning. Laurus Labs is another one that I would pull up. You have consistent quarterly dips. In fact, the net profit is down 88%. We will be speaking with the management a little later and figuring out what's happening there, but you're seeing that punishment there, the beating with a 5% cut in opening trade on Laurus Lab. Titagarh Rail and RailTel is the other one I would look at. RailTel, of course, had numbers out, but Titagarh Rail has a JV agreement with Amber Unit Enterprises, and they'll be carrying out the business of railway components. The entire rail pack has been on a rush and on the fast track, so to speak, and Titagarh Rail also looking good this morning. RailTel on the back of numbers. You know, their profits and margins have been squeezed, but because of higher project costs, the street not looking at it too negatively at all. So that's interesting to see as well. I would just round up with a DLF again, because the real estate pack has run up so much. Look at this. The PAT is below estimates, but the stock is 2% up, because look at the kind of uptake they are getting. One of their projects recently, and we spoke to the management as well, your signing amount, your basic signing amount has gone up from, say, a 5 lakh to a 10 lakh. And on that order flow and that pipeline, you have a DLF up this morning as well. So real estate and railways continues on the fast track, Samina, this morning.
Add to those, there are some other very interesting names that are actually looking good. Hoodco is looking again pretty sweet this morning. If I can get Hoodco on the screen, it would be useful. 11% up move is what we... I'm not sure why. Okay, this is probably a discrepancy between what I have and what the screen is showing. But there will be lots of other earnings. If we can pull some of those broader market movers in trade, it would be useful. Bajaj Auto, Siad, Balakrishna, TVS Motors. If I can get those on the screen, that'd be good. Siad, good numbers. Stock is down 2%. Bajaj Auto is also trading with a gain of about 1.5%. You've got Indian Bank on back of numbers, so you've got a bit of a move there. DCB Bank, if I can get that one up. PNB Housing Finance should also be seeing DCB is getting a thumbs down, 2.5% lower. PNB Housing is getting hit actually, 4.5% cut on the stock. You've got Dalmia Bharat. Again, reported numbers, not a good picture for Dalmia Bharat either. TVS Motors also getting hit by 2%. Max Health trading with a slight bit of a cut. So all in all, the result reactions are sharp. Z again taking it on the chin after a big, a small recovery yesterday. The stock is seeing some more selling pressure at these levels, at least what we are seeing. But tire companies, despite earnings being better than expected, the whole tire company space is weaker. Now, this could be a daily play on back of the way crude is trading this morning. It's, of course, about levels of $80 a barrel. That's a key raw material for tire manufacturers, and that could be reflecting on some of these stocks. So, all in all, it's not a very exciting morning. We were expecting a subdued start, largely on back of a little more profit-taking emerging. Yesterday was a pullback rally. This morning, that's not sustaining. And Bank Nifty, once again, not pulling it together. HDFC lower again in today's trade. So it's open lower for the third straight day. Yes, it did recover a little bit in trade yesterday, but down again 1% on the bank. Rahul, you want to come in? Okay, we've got Kush as well joining, who's with us. Kush, quick one. How would you trade the Nifty this morning? 21,400. It seems like that could be threatened in the next couple of minutes.
Samina, I'm just going to respond to Rahul, Kunal, whatever else you want to keep calling, since I'm the only technical guest on it right now. So, no, that's on a lighter note. Well, this is exactly in line. I mean, we said 21,500, 550 on the upside on Nifty and 45,000 on the Bank Nifty. So I think it's in line. I wouldn't be surprised to see some sort of profit booking come in from, the green territory that the Bank Nifty is trading in right now. So those are the levels that I'm looking at. On the upside, if we were to break, then 45,500, the level which we briefly touched yesterday, or just, move to closer to those levels, is something that I will have on my radar. If we take out the previous day's high, that's when, serious short covering can come in for the day. But I somehow don't see that happening yet. Even the options data, it's been 5-6 minutes, to the start. But even the options data suggesting that 21,400 is a good base on the Nifty, and 21,500 is a resistance, and 45,000 is turning out to be the pivotal level where the index will hover.
I just want to highlight what's happening with real estate this morning. India bulls up 2.5%. Macro tech is not just a DLF story in a meh kind of market where there's not too much of a move. Flat as a pancake is our phrase of the day. You're seeing some signs of life here, definitely. Prestige, though, down in the red about 1.5%. Kush, any favorites over here? Anything that you think is worth accumulation at this point?
Prestige, very clearly. In fact, I see the downturn that's come in the stock from about 1,400 odd levels. It's just made the stock, a little more attractive for me. This is actually a very interesting technical support zone, also a 50-day moving average support that the stock has taken. So this is a good opportunity to, accumulate or start, buying in Prestige estates. DLF, obviously, the level that we spoke of in the morning before, the market started 765. If you see, we did open just above that, but then, we've again slipped below it. So I will have DLF also on my radar, but if I were to just pick one, then it would be, Prestige estates.
All right. Anything on Laurus, Kush? Getting hit badly because of the numbers, but Laurus and healthcare space.
Well, Laurus is a very clear avoid, has been for a while now. Even the recent move that we had seen, which did actually pull up the stock up until 450, wasn't a very convincing one. It was just a couple of days of sharp up moves that, actually dragged the stock higher, but then it's just giving up all the gains. So for me, Laurus is a very clear avoid. A very strong level that I'm looking at is 350. Currently, the stock is below its 200-day moving average, suggesting that, this weakness could continue. And 350, if that level breaks, then, perhaps we're looking at, 320 also. So Laurus is a very clear avoid for me. Tamanna, I'm sorry, what was the other question?
Healthcare. Anything in the healthcare basket that you like at all?
A couple of names. So Spark continues to, shine and be on our radar for a while, even though the stock's gone into a bit of a profit booking. But, put it in context that it, zoomed, it literally zoomed from 240 odd levels to 400. So even the dip that we are seeing, is close to its 20-day moving average where the stock's taking support. So I would look at an opportunity to accumulate Spark. And one stock that we've liked for a while now has been, Railbow Children's, Medicare. This stock also has gone into a bit of a consolidation mode, but these are times to accumulate them. So Spark and Rainbow Children's is something that I have on my radar. One sector that, we've not discussed and I'd like to put on, the viewers' radar, your radar, is the power sector. A lot's happening there. NLC India, Trill, TRIL after yesterday's upper circuit is also strong. Tata Power, a stock that we discussed in the morning. So there's some strength in the power space, even this morning.
Okay, that's a good point. Yeah, you're right. Some strength in this space this morning as well. This whole renewable energy push is going to be a big theme going ahead. So good idea to point that out. Thank you so much, Kush, for joining us. Great to have you this morning. And of course, a happy Republic Day in advance. Dinshaw Irani is with us now at Helios Capital Management. Dinshaw, very good morning to you. Great to have you on the show, and an interesting time to understand what's happening in the markets right now. So are we seeing a hesitation ahead of key events? I mean, I'm not talking only about today, where you're going perhaps into a long weekend. You have a weekly and monthly expiry all bunched together, but you have a 1st Feb event. How big is that on the radar for you? Because while it's a vote on account, 2019 has taught us not to really dismiss the pre-election budget.
Good morning, and a very good morning to you, your viewers, and your team as well. But anyway, so basically, 1st of Feb, I don't think will be a major event to look forward to. It's a vote on account, and actually the FM has also made it very clear that there's not going to be any big bang announcements. It's just going to be a sign-off and an extension of the previous budget. I think the bigger one will be the July budget when it comes about. That will be the one which will set the trend. But one more thing I want to highlight is normally the corrections, whatever is happening right now in the market, I think it's mainly a bull market correction which is happening. These corrections are driven by non-events, right? I mean, there's no specific negative event which is driving down the markets or giving it a trend. Having said that, even on the valuation front, I think we are slightly more stretched than what we have been in the past. If you look at history, we probably are a standard deviation away from our average valuations for the last 6-7 years. So that, I think, is the one which is really keeping some kind of putting some kind of doubts in the investor's mind. But normally valuations are, the corrections are not that deep. They're more of shallow, and our feel is this will be more of a time correction than actually a price correction going forward.
Time on that correction, then in that case, Mr. Irani, if you're saying that this is a correction which was in the offing, the view or the question then is how much more to go? Have valuations stretched to that extent that we need to let out some more froth?
No, so basically, I'm not saying that it was bound to happen, right? Nobody can predict that. Yeah, but the fact is that we were looking at some apprehension in the market, and frankly, I mean, our feel was that it was mainly going to happen in the mid and small cap space. That looked very frothy. The large cap space has, I mean, if anything, it's been in line with the past history as such. And obviously, there were pockets which were looking very, very frothy even in the large cap space, specifically the IT space, I think. So obviously, I mean, that is where you should see some kind of corrections. There will be pockets of corrections happening. There are certain pockets like FMCG or paints where the valuations have got stretched, the fundamentals are not keeping pace. So obviously there are reasons for corrections to happen, and that's what our feel is.
Just a quick view from you, Dinshaw, on the whole sort of private banking upheaval. It seems like perhaps HDFC Bank has been punished a tad much. Do you think that's the view? And do you think that private banks are now becoming available at great prices because of some of that fear, or you would stay away right now from that space?
No, I definitely agree with you. I think the kind of punishment meted out to HDFC Bank for not having garnered deposits to the extent that the market was expecting was a bit too much. I think it's basically now cheaper than ICICI Bank, which has never been the case ever in history for HDFC Bank. And look at the franchise, strength of the franchise. I think that you cannot ignore. If this bank has a problem, and by the way, I was told that probably it was a voluntary decision not to raise deposits so aggressively because they already had quite a heavy liquidity in the system as such, and they weren't too keen on raising money to that extent on such an aggression. So basically, I think if the strength of the franchise is under question, then obviously, if I'm talking about the HDFC Bank franchise, then obviously the whole sector comes under a question. I still remember a statement made by Aditya Puri long back that if I were to lose my shirt, the others would be running around without clothes. So obviously, you can imagine the strength of the franchise out here. So we'd rather stick to this. And it's, by the way, just to give the thing that's number one holding for across our funds.
Interesting. Yeah, well, let's see if it regains its shirt. Dinshaw, good morning. I want to take a case of a stock that is has got the street divided right down the middle, and I'm using that as an example, of course. But Laurus Labs is a case in point, down another 6% today. Now, we've heard stories of CDMO and how CDMO businesses, slightly longer term in nature, RT and the Glenmarks of the world have gotten some contracts, and why these businesses have long gestation periods. Now, my question is, for the whole CDMO space, maybe Laurus individually, but the whole CDMO space, here's a business which is probably building capacity, but listed in the public markets, which wants validation every single quarter or every half year, which is not coming through. Are these businesses good to invest in, one? And even if they are, is it better to time them well, and is maybe today or right now not the time?
So I won't comment on Laurus specifically, sure. But let me talk about the CDMO business a bit. Basically, what do you look for in that? You look for the molecules which are closer to phase 3 or late phase 3, right? And that's where I think probably Laurus was lacking. That CDMO part of the business wasn't. It's a new one for them. It's not been an old business for them, and that's why I believe they must have. I really don't know much about Laurus. We weren't too keen on that stock, anyways. In fact, my analyst had a sell on that stock. But the fact was that maybe that was the problem there. But there are others in the segment who are pretty sticky, because when you get closer to a phase 3, I mean in trials, I'm saying there's only 1 or 2 suppliers who can supply those kind of scale-ups, right? And as you come to the market, the real scale-up happens. That's when the real commercialization of that molecule happens and the bulk of the supply start. So that's what you need to look for, and I think that was probably was lacking. So any other CDMO player, I think that's what you want to look at, the portfolio of products, how many are there in the late phase 3 or even the late in the phase 3 stage, and then take a call on those accordingly.
Okay. Well, thanks for that insight, Dinshaw. Really appreciate. Stay on. Lots more to talk to you about. We need to slip into a quick commercial break. On the note that not too many stocks are up and about. Maybe a couple of real estate names like Suntech are doing okay. There's some strength in some of the solar names. Adani Energy Solutions, SW Solar, and few others seem to be doing okay as well. We'll be back in just a minute from now and continue a conversation with Dinshaw Irani.
Welcome back. You're watching India Market Open. It's not looking too great on the street. Lots of earnings reaction. Stocks like Masgao Docs also up on back of order wins. But we have with us Dinshaw Irani, who's talking to us about how he feels about the markets and his views on companies or banks like HDFC as well. Mr. Irani, I want to talk to you about another space, which is premiumization of the Indian consumer story. Now, this has been quite a talking point, at least in the last quarter or so. How would you play this premiumization story? Would you play it through premium real estate? Would it be premium consumption, or even premium alcohol? What do you think is a story here, and is it really worth betting on at this stage?
So actually, it is, because what you learn from history is you never try to learn from history, but we try, right? And that's why when you see these other economies where the per capita has moved up sharply the way it is expected to happen in India, it's obvious that the discretionary spends will become much and more and more picking up more and more in the country as such. And that's why we believe that the best way to play that would be through, I would say, discretionary, affordable luxury and stuff like that. So tourism is a one big play for us in that segment. I think that's the way to play. In fact, you've seen that, right? I mean, the domestic tourism itself is now demanding quality rooms. Earlier, 1-star or 2-star used to do, but with the spending power coming back to for domestic consumers, they're demanding real quality rooms like 3 and 4 stars, and there's a dearth of those kind of rooms in the country, and that's why we are very gung-ho on the tourism space as such. Even the ancillaries who are into tourism, we are fairly kicked about. In terms of real estate, I think there's too much froth out there, frankly. I mean, we did play it through one particular stock, which was in all the facets of real estate, which was retail and commercial and residential. But we moved on that stock, and we're not too comfortable with the kind of frothy valuations that we are seeing in that space. So we'd rather avoid that.
As you smiled so wide because you called this trend, Niraj and Tamanna both indicated that you were the first one to call out on this premiumization trend, and hence the joy. But talking about picking trends and identifying future stories, last year was all about rail, was all about defense, it was all about government-focused sectors. As we stand at the cusp of a new year, an interim budget, elections, if I had to ask you to pick trends or sectors, what would those be for the next year or two?
So basically, we're very kicked about, as I said, that what you when you see other economies which do the way we are expected to do, two sectors stand out totally. One is consumption, because consumption really drives economics. I mean, capexes can work to that much, but the consumption story has to kick in, and that's where the domestic consumption. That's why we are so kicked about the domestic consumption space. Again, one caveat here is the discretionary consumption, not the FMCG kinds, because I think the rural economy is still under a lot of pressure for FMCGs to pick up in a viable manner in the future. And the second space that really does well is financials. And that's why both these spaces, and when I say financial, I'm talking about the BFSI, rather less of higher than the BFS space. Yeah. And here again, if you look at our portfolio, almost 2/3 of the portfolio is invested in these two segments per se. Plus, you will have some kind of, as I said, that financials not only help in consumption, fuel consumption, but they also help in the capex, which is needed to fuel that consumption, right? So you'll need to have some capex-related stories. India has been looking at PLI, so you need to have some PLI-related stories. You need to have some defense-related stories. Our field on defense is that it's not only about indigenization of foreign tech, but the defense companies in India will definitely become an outsourcing base for the world as such, because the world is now spending more and more on defense thanks to what's happening, the geopolitical tensions which are happening across the globe, right? So that's why that would be one very interesting space to look out for. And obviously, certain outsourcing stories will always work, like one which we talked about was CDMO space. I think that's another space in pharma, domestic pharma as such, and stuff like that. I think these are the major sectors that we are invested in. I think that's where we look at major growth going forward.
Dinshaw, I just wanted to follow up on the comment you made on the tourism play, and with the whole Ayodhya event. We saw a number of stocks go up before, continuing to after. We spoke to a large number of companies who are looking at serious capex and this spiritual tourism movement. Now, how do you decipher just headline-grabbing news as opposed to companies who really have the wherewithal to turn this into something solid? So when you're saying you're bullish or long on the tourism space, can you get into a little more detail on that? What you like and what kind of companies you like?
So I won't gave out the names of companies, and obviously when I said tourism, I mainly meant about the ones which are actually there, the hotel companies, right? So they're doing pretty well. And in fact, I think it was a fantastic job done by our Prime Minister on how the whole Ayodhya thing was the televised as such. And I think that actually will add to the tourism. I mean, you talked about spiritual tourism. I think even when spiritual tourism happens, obviously there'll be certain spillovers to the actual tourism too. So that's why we believe that this is the space you need to be in. Obviously, when I talk about NCDs, I'm talking about the ones which are helping out in tourism as such. So be it travel companies and stuff. So that's what we're pretty kicked about right now.
Right. So travel companies and hotels is what is actually going to gain very clearly from the tourism boom, as per Dinshaw Irani. Thank you so much, Dinshaw, for joining us. Great to speak with you on the show today. We're taking a very short break, but on the other side, we're talking to the management of Birlasoft. We're breaking down their December quarter numbers and a lot more. Stay tuned.
Welcome back. You're watching India Market Open. The market's trading flat as we speak. It was a down start on the street, sub 21,400 on the Nifty, 0.3% lower. But the story this morning is about earnings, and that's what the markets are focusing on. And one such standout earning has been Birlasoft. It's been a street favorite, a multi-bagger, various definitions of this one, outdoing the market right now, up with a marginal gain on back of a pretty solid set of earnings posted by them. Angan Guha, MD and CEO of Birlasoft, now joins in. Morning, Mr. Guha. I guess you've got this quite a bit since you posted your numbers. numbers. It's been a pretty good quarter on the face of it, and you've largely outperformed the industry, internal expectations. Lay it out for us. Tell us how it's been, and of course, looking ahead as well in terms of guiding us in terms of revenue. How does that look?
Thank you for having me on the show, and good morning. So look, we've had a good quarter. I mean, it's a seasonally weak quarter, as we all know, but even then, I think we've executed very well. As you know, our numbers are, revenue numbers are up almost 2% quarter on quarter. I mean, rupee terms, 2.5%, and in rupee terms, almost 10% year on year. So from that perspective, I think it's been a very solid performance. But I think even the bigger performance for us has been our earnings growth. Our PAT has crossed 150 crores for the first time in our history, and we are pretty proud of that.
Right. Let's talk about vertical breakdowns. BFSI, manufacturing, I know has done quite well. 2 quarters ago, you talked about how life sciences would be seeing a pickup. Are those expectations playing out as planned or expected in that sense?
Yes, clearly. I mean, like you pointed out, our manufacturing business is very strong. It has done well. Our life sciences business has bottomed out. It's turned the corner, and we are seeing growth in that. Our financial services business, because of the furloughs quarter, is seeing a little bit of a dip. But I'm not very worried about that. I'm sure the financial services business will also pick up starting Q4. So all in all, it's a broad-based growth as far as we are concerned. And I think the team has done a good job in execution, which clearly shows up in our numbers.
Mr. Guha, what happens going ahead? Do you expect the same verticals to continue to contribute to your top line? Are you betting big on other verticals that would pull through? Just guide us and help us understand what the industry dynamics really look like, and where are you really seeing inquiries, conversations, deal signing?
Yeah, so the markets are still very volatile. I mean, it is hard to comment in terms of how the economy is going to move going forward. I don't think the economy has changed, and the macroeconomic situation has not changed too much in the markets that we serve. So we'll have to wait and watch there. From a verticals perspective, as I had stated earlier, we'll be focused on the 4 verticals that I had called out, which is financial services, manufacturing, healthcare, etc. So I think we'll be focused on those verticals. Our energy utilities vertical is also showing significant growth. So I'm pretty confident that the current 4 verticals that we have called out, just by focusing on them and focusing on key markets, we can sustain the growth.
What about margins, Mr. Guha? You had guided a couple of quarters ago saying that, you would see a good run rate of EBITDA margins at 16%. And you've managed to do that despite salary hikes that have been undertaken, incentive payouts. You think 16 is a good number, and is that the number internally as well? Or do you think margins could push further from these levels, at least in terms of internal objectives that the company has?
Look, our objective is always to kind of invest in our business because one is the quarter-on-quarter performance, which is important, but equally we are investing for the long term. And we've got a lot to do when it comes to our domain, creating technology capabilities, entering new markets. So it is going to be the next 2, 3, 4 years is going to be a lot of investment in the business. So we want to keep our margins in a narrow band. Now, obviously, we do not give guidance in terms of how our margins or revenues will move. We will be focused and take one quarter at a time and keep executing for that quarter. But our investments will continue.
But fair to assume, Mr. Guha, that 16, is a sort of good ballpark where you would be trying to deliver at?
I think so, in the sense that, again, it's a little difficult question because it is a manifestation of the kind of orders we pick up, the markets we serve, the macroeconomic situation. But, our endeavor would be to keep the margin at a very, very narrow band while we continue to invest. See, we are looking at a lot of investments going forward to build a long-term sustainable business, and that's important for us.
And that brings me to your next question. What is it looking like on the demand side? What's the time that you're spending on your business cycle, closures? From a decision standpoint, are things slow? And if they are slow, what are you doing to negate it?
So it is slow. I mean, it's like I said a little while ago, I don't think there is too much amount of change in the macroeconomic environment, and we'll have to kind of see how things pan out. But our pipeline is improving, which is obviously a good news. We've had, good order signings over the last 9 months. If you look at our 9 months number, it is almost 10% higher than the corresponding 9 months a year ago. So that's a positive sign. So look, we are cautiously optimistic and we are working with our clients in the transformation journey. I'm confident that, we will continue to execute well for our clients. But it is obviously a little hard to say in terms of exactly what number we deliver in signings in 4Q or beyond. But we are feeling a little bit more cautiously optimistic as we go forward.
Talking about geographies, US clearly has been a little bit of a pain point, no clarity, while some are calling it green shoots, others are saying it's non-committal in terms of on-ground activity. I did look at a couple of interviews you did where you said that, you would be also looking at other geographies. In fact, your CFO has also talked about that. What's the plan there? What sort of geographies are you focusing on? Investments are being made in new geographies as well?
Yeah. So, first of all, let me comment on the US. The US is a big business for us. As you know, it contributes 86% of our revenues. And we will continue to be invested in the US. I mean, it will deliver industry-leading growth for us. We are feeling more and more confident of serving clients in the North American region. But equally, we want to diversify our revenue base, which is why we've hired a CEO for the rest of the world who's going to manage all geographies outside the Americas. He's going to be based in London. So under his leadership, we will be investing in people. We'll be investing in markets. Now, it's a little too early for us to say which markets we will be focused on. But we've committed to all geographies that we work in and where we serve our customers. And we want to definitely broad base our growth.
Right. I mean, everything on every front, I think there's been a beat. Even your attrition has come down significantly from the second quarter level of 18% to now 12.6%. So clearly, first quarter rather, steps in the right direction. You want to quickly comment on attrition for me, Mr. Guha? And also, tough to find a sore point apart from the fact that the macros may not be very supportive at this time. But anything that you're concerned about as you run this company, I'm sure there are things that keep you awake at night that, we'd like to know just to be a little more mindful when we view these numbers.
Yeah, look, the last 4 quarters has been incredible for us. I mean, we've delivered on all parameters like you've noted. But look, the job is yet half done. We've got to invest in a lot more areas like I talked about, whether it's domain, whether it's technology, whether it's newer markets. But we're quite excited with the possibility that the market presents to us. The attrition, again, is currently at the lowest levels it's ever been. I think the attrition will continue at the current levels for at least a couple of quarters till the markets turn. I think the team has done a good job on all the people's policies. I mean, we've promoted people. We have given a wage hike. We are investing in our people. We are investing in training. So by and large, I think we are on the right track. But look, we don't know what we don't know. We don't know what the future holds. But our job will be to take one quarter at a time and execute for that quarter.
But you are feeling optimistic at this stage, right?
Well, let me say I'm feeling cautiously optimistic. I mean, optimistic is a very tough word in today's market, but cautiously optimistic, definitely.
Indeed, I'd love to have chatted with you longer. It's exciting to see how Birlasoft has been, beating the trend quarter on quarter, and I think on every parameter it's looking good, while the macros still seem challenging. Congratulations, Mr. Guha, once again. Have a great long weekend and enjoy it. We'll speak to you soon.
Thank you so much.
With that, it's a wrap on India Market Open. But as we get closer to the budget, NDTV Profit gets you top corporate voices and their expectations of the upcoming budget. Here's what National General Secretary Praveen Khandelwal of Confederation of All India Traders expects for the trader community from this budget.
We are awaiting of a national retail trade policy, as also announcement of e-commerce policy and the rules under Consumer Protection Act. Whereas we have also requested that, as Prime Minister has said, one tax, one nation, one tax. So we have added one more thing, that is one license.
Well, Profit Insights today has a conversation with Laurus Labs. The 3Q sales were subdued on a high base, but even normalizing for the impact of the COVID-related order benefits last year, sales grew by about 6%. And while gross margins have improved and they've stayed above that 50% mark for a while now, due to the negative operating leverage due to the growth in investments, continue to keep the EBITDA margins at 15% for the third quarter on a trot at the very least. Dr. Satyanarayan Chava, founder and CEO of Laurus Labs, joins in to talk about the quarter, the first 9 months, and what's the outlook, which in the con call seem to be a bit more constructive. Dr. Chava, good having you. Thanks so much for taking the time out and speaking to us here. Niraj here, good morning. I want to start off, Dr. Chava, by talking about a comment that I picked up from the con call, wherein you said that the volatility was driven by the timing in some of the CDMO-related businesses. Could you explain that in some more detail, sir?
Niraj, good morning. See, as we mentioned in the previous con calls, the H2 is going to be better than H1. And we are committed to that statement. And as we have seen, the numbers, what we are looking at for the Q4 are looking attractive. And that's the reason we believe the worst is behind us and good times are above us. The segments, what you can see, the generic API, ARV API is stabilized. And where we are guiding that ARV, both APIs and formulation put together, will reach a plateau around 2,500 crores, give or take 100 crores. So we are at that level last year, this year, and next year also. We anticipate the ARV revenues will be in the oncology, as we have seen from quarter on quarter, we are delivering better numbers. It is also surprising for us we are doing so well in oncology. And our numbers for next year, when we are putting our budgets, are even more aggressive. And then our CMO business in generic APIs is also doing good. So this is the area where our deliveries were deferred by our partners to Q4. That is one reason where we didn't increase our numbers. And the other is some of the deliveries in CMO also were deferred by several weeks. These are the reasons for not so good performance in Q3. But the gross margins were very healthy at little over 54% in Q3. And in Q4, not in Q4, see, we have delivered that kind of gross margins for several quarters, as we mentioned in the past. And any quantum of business improvement will definitely help our EBITDA margins to go about 20%. That's also looking very promising in this.
Okay, since you've started with the big overall picture, I'll do that and then I'll come to specifics, particularly CDMO. You mentioned in the call as well that the slower Q3 performance will rebound from quarter 4 onwards. FDF, optimum utilization from Q4, pick up to Onco will probably continue, scheduled CMO delivery, etc. So is there a marked improvement, Dr. Chava, that you expect in quarter 4? Because for H2 to be better than H1 as well, relative to what you've done in Q3, there needs to be marked improvement, not from just a top line perspective, sir, wherein you are steady. But the bottom line numbers look a lot lower than what were estimated by brokerages.
You are absolutely right, Niraj. When we are saying the Q4 will improve, see, I'm giving a number. So in any improvement in our sales, assuming you do 54% gross margin, continue to do in Q4 as well. So 100 crore gross margin extra, most of them will flow into EBITDA. And then the EBITDA margins from current 15% level, I'm sure from Q4 onwards will move towards 20 plus range.
So you expect revenue numbers to be good, and on these stronger gross margins, there to be line item by line item some bit of improvement as well. Okay, since we're talking of line items, Dr. Chava, just one quick word that I picked up in a couple of notes and a couple of messages that came to me, and that's around two things. One, the net debt or the leverage, which is at a high, I mean, 1.4 times the past 2 years, has inched up significantly, maybe at levels which were last seen a few years back. Now, arguably, on the back of the increased investments that you've done, do you expect these numbers to inch up further as you continue to invest more? Or do you believe these will stabilize or probably show a trend lower in FY25?
I think we have reached our peak debt levels. We don't expect the debt levels will increase further. And FY25 will see significant reduction in our ratios. In the sense debt by EBITDA, we are close to 3. It will come down very well in the FY25.
Okay. Okay. And since I'm on numbers, so before I come to the business segments, line item by line item, the other aspect is, of course, by virtue of the fact that there's a higher gross block addition. What is it, about 6,000 crores currently? Your return ratios have come off. Do you reckon that for the near term, these could be the nature of the return ratios, or do you expect improvement there too as utilization levels improve?
See, we have two options, Niraj. See, don't invest in the opportunities where the company will do significantly well in the future. If we decide not to invest for next 5-6 quarters, we can return our debt. Is that the right thing for the company? When the entire world is looking at diversification, when they look at diversification, they have to see the scale for them to have confidence in good business. So we have taken a judicious call to invest and secure future, although our current is a little bit painful. And we are very conscious and judicious in our investment. As you have seen, our animal health, we have invested close to 300 crores. We are again investing another 50-60 crores to build one more block. That is based on a long-term contract. We just validated one product there, and we are validating another product as we speak. So the validations in that animal health facility will be completed by March, April 2026. That is the kind of plan we have in place for many initiatives. Apart from CapEx, we won't talking about CapEx, but we also invested 450 crores in non-CapEx related investment aspects. We invested 300 crores in Laurus Bio, in the equity, and about 120 crores in Immunact, and another significant money in licensing patents from Mahindra. These investments are very, very good for the organization in the medium to long term. Currently, when CDMO customers come and visit our facilities, they definitely go to our bio facilities because there are very few companies who can do fully integrated enzyme engineering, enzyme manufacturing, and biocatalysis fermentation. So people are very happy to give their projects because of our enhanced technical capabilities in that space. So if you put CapEx and these equity-related investments, we have done 3,500 crores in the last 3 years. And that is very important for company sustainability in the future. As I have mentioned, we have to diversify, and each diversification step will create some pain initially, and the gestation periods are 3-4 years. So we have taken many initiatives of diversification at the same time. That is also giving some additional pain for us, but there are many positives right now. So we are having less concerns because we increase our debt, we increase our gross block, but we are cementing and securing our future.
Most certainly. No, I'm not one to tell you, Dr. Chava, that you shouldn't do X or Y, but because you're a listed entity and because there have been comments made in the past about from when does this recovery start to come in, and because due to an issue or two it might be getting delayed, and hence my question around what could happen to the numbers in that interim period. I will get to from the number line items as well, but this question around the lower return ratios, do they stay like this for the foreseeable future until the pickup happens? Or do you expect a pickup, say, in Q4 or Q1 or Q2? Or that is wrong to expect right now?
The pickup will start from Q4, and we expect that will continue.
In the return ratios as well. Okay, great. And just before I take that break, Dr. Chava, you believe that your gross margins will stay steady at 52%, but because there is an expected pickup in Q4, there might be an uptick in EBITDA margins as well, because you mentioned that this will flow straight to EBITDA, some bit of it, and then therefore to the bottom lines as well.
Yeah, you are absolutely right. See, last several quarters we were able to maintain EBITDA gross margins above 52%. And last quarter was 54.4%. And we expect our gross margins will remain in that range.
Fair call. Dr. Chava, lots more to talk about on the specific line items, particularly CDMO, the animal health project, which I would love to know more about. We'll take a very quick break, come back and continue our conversation with Dr. Satyanarayan Chava. Back with Profit Insights in conversation with Dr. Satyanarayan Chava of Laurus Labs. Dr. Chava, I want to get to some specifics now. We were talking about the CDMO piece and the animal health project. Now, I believe a couple of notes that I read stated that the animal health project has been delayed by a couple of quarters. I would love to get some clarity here. What happens here? When do we see validation, so on and so forth? When does the market see some bit of numbers coming out from there, depending on the plans that you've laid out?
The animal health business, our contract with our partner is for more than 20 APIs. Some of them are still patent protected. And one product which they are filing NDA soon. And there are several products which are generic. And our schedule, when we signed this agreement 2 years back, we're supposed to complete all the validations by end of 2025. Based on the current timelines, what we foresee, this will be delayed by a quarter, and we expect to complete the validations by March, April 2026. This delay, partly because of few weeks qualification delay of the facilities and few weeks delay from partner because of their increased analytical and regulatory requirement of API. Otherwise, this program is running very well, and several products were lined up for validations right now.
Got it. Just so that I understand this better, Dr. Chava, so therefore, one of the beliefs is that one of the notes, for example, Citi, which has come out with a note, says that they expect synthesis sales to remain range-bound until the pickup in the animal health project that has witnessed some delays. I would love to understand from you. You mentioned, let's say, timelines of April 2026, which is Q1 FY27. My question, therefore, is that until then, do synthesis sales remain range-bound, and would animal health revenues from this project start only after all the validations are done, or do you do part commercialization